Chapter 3, the adjusting process. The accounting period concept requires that revenues and expenses be reported in the proper period. So basically, if we have our power bill for January, we receive the bill in February, but we still need to record those expenses in January because the expenses occurred in January. The accounting period concept. Under the accrual basis of accounting, revenues are reported on the income statement in the period in which they are earned. So if we earn money in January, we need to report it as of January. GAAP requires that companies use the accrual basis of accounting. GAAP is generally accepted accounting principles. And the accounting concept supporting this reporting of revenues is called the revenue recognition concept. Under accrual accounting, revenues are recognized when services have been performed or products have been delivered to customers. Revenue is measured as assets received, such as cash. Revenue is measured as assets received, such as cash or accounts receivable, in exchange for a service or a product. This process of recording revenues is called revenue recognition. Revenue recognition determines when revenue is credited to a revenue account. The accounting concept supporting revenues and related expenses in the same period is called the matching concept. So we're matching same period. The matching concept states, can't talk, like, the matching concept states that the revenues and related expenses should be reported in the same period. We're matching it to the same period. And then under the cash basis of accounting, revenues and expenses are reported on the income statement in the period in which cash is received or paid. Under accrual basis, some of the accounts need updating at the end of the accounting period for the following reasons. So we may need to update accounts if we have some expenses that are not necessarily recorded on a daily basis. Some revenues and expenses may be incurred as time is passing by, and revenues and expenses may have just not been recorded. You may not have recorded them. And this does happen in real life. So at the end of the period, one of the main things that people do in accounting, bookkeeping, office assistants, depending on what their job descriptions are, is they look over and make sure that all revenues and all expenses are recorded in the on record in the books, and that they're recorded correctly. And looking at that bank statement, making sure that everything that hit the bank is also recorded in our system as well. The analysis and updating of accounts at the end of the period before the financial statements are prepared is called the adjusting process. The journal entries that bring the accounts up to date at the end of the accounting period are called adjusting entries. All adjusting entries affect at least one income statement account and one balance sheet account. So the adjusting entry affects one income statement account and one balance sheet account. Prepaid expenses, that's things that we have paid ahead of time. It's the advance payment of future expenses, and we record those as assets when cash is paid. So remember, prepaid is going to go over here. It's an asset. Unearned revenues are the advance receipt of future revenues. So we record it when cash is received, but we have not earned it yet, so it's unearned, it's a liability. Accrued revenues are unrecorded revenues that have not been earned, but cash is yet to be received. So we haven't earned it. We don't have the cash for it yet, but we expect to get it, so we're going to go ahead and accrue for it. And that goes the same for expenses, just opposite. Accrued expenses are unrecorded expenses that have been incurred for which cash has yet to be paid. Fixed assets or plant assets are physical resources that are owned and used by a business and are permanent or have a long life. As time passes, a fixed asset loses its ability to provide useful services. This decrease in the usefulness is called depreciation. All fixed assets except for land lose their usefulness and are said to depreciate. Land is the only thing that does not depreciate. It normally increases in value. As a fixed asset depreciates, a portion of its cost should be recorded as an expense. The fixed asset account is not decreased credited when making the related adjusting entry. This is because both the original cost of a fixed asset and the depreciation recorded since its purchase are reported on the balance sheet. Instead, an account entitled accumulated depreciation is increased or credited. Accumulated depreciation accounts are called contra accounts or contra asset accounts. Let's see. Is this in here? And if you want to see examples of any of these, you can kind of start on page 105, which is chapter 3. But you'll see there's some journal entries. It just shows the journal entries, the T accounts. Trying to move that and I can't move it. But we can still read what's behind it. This PowerPoint, it looks fine.
That chart right there is on page 117. If that's what you're. And right there in the middle of page 117 on the depreciation expense, that chart.
Okay, yes, I see that. Thank you. So the normal titles for fixed asset accounts and their related contra asset accounts are as follows. So here we've got an example. We've got the fixed asset accounts and we've got the contra asset accounts. Land does not have a contra asset account because it's not depreciated. Buildings, store equipment, office equipment, those all have contra asset accounts because they do have depreciation, and their contra asset account would normally be an account that's called accumulated depreciation building, accumulated depreciation store equipment, accumulated depreciation office equipment. Companies can kind of name these accounts whatever they want, as long as it's within. Some of these names may differ slightly. So instead of, you could see accumulated depreciation buildings, you could see accumulated depreciation building, you could see accumulated depreciation GMC Fairburn campus, accumulated depreciation GMC Milledgeville campus. So the names can change as long as they still represent overall what it's supposed to be. But you do have contra asset accounts for those types of accounts, buildings, store equipment, office equipment, because they do have depreciation. Land does not have depreciation.
So this is normally your durables.
I'm sorry.
Durables, things that normally will last a long time, but will depreciate less.
Yeah, I mean, realistically, everything, well, most everything depreciates. I mean, this chair depreciates. Eventually, this chair is going to be, it's already kind of wobbly, but you know, maybe eventually it's just going to be so old that it's not really,
Gonna be usable.
yeah, it could break or something. And that goes into even more subjects. We're not going to go down that road because I don't need to know all that. But pretty much just about anything can be depreciated. I mean, even your jacket. So, I mean, nobody. The thing is, I mean, there's also a limit to how far you go. Like, I worked with one company and we had a minimum of $1,000. So anything that was $1,000 or more, we would depreciate, and we'd track the depreciation on it. Anything that costed less than that, we would not, because we're like, so we need to depreciate, you know, that's a lot of stuff. Pencils, pens, staplers. I mean, you know, come on now. It's a $10 stapler. The amount of time that it would take us to depreciate the stapler every single month for $10. It costs more to pay somebody to do that.
Exactly.
So,
That's what I was gonna say. It's not cost efficient.
no. So, I mean, and companies have different, you know, thresholds, which is what that $1,000 was. It was like a threshold. Some companies, they don't look at they, you know, they depreciate 500 and up. Some of them may require higher than that. Depends on the size of the company and how many assets they have and stuff like that. So, but you can get tax breaks on depreciation. So, you know, but there's also to an extent of how far you're going to go with it.
It is 50%.
No, ma'am. So the difference between the original cost of the office equipment and the balance in the accumulated depreciation office equipment account is called the book value of the asset or net book value. So looking at the equation, which probably makes it a little bit easier, to get the book value of the asset, you're going to take the cost of the asset minus the accumulated depreciation of the asset, and that's going to give you what the book value is. So we bought something, we paid $10,000 for it, it's on the books for $10,000. At the end of the year, we depreciated it by $1,000. So we're going to take that accumulated depreciation of $1,000 off, and now we're going to be left with a book value of $9,000. I'm on the wrong page. That's just because it's jumbled. I was like, what happened? So that's how we do that. Sorry, it's jumbled up on this screen. The purpose of the adjusted trial balance is to verify the equality of the total debit and credit balances before the financial statements are prepared. Comparing each item in a financial statement with a total amount from the statement is referred to as vertical analysis, which you do a lot. We just don't necessarily call it vertical analysis. And now we're at our practice problems. Again, I think we've got like maybe 10 practice problems.
Number 2.
Yeah, that's what I was thinking.
Are adjusting entries the same as correcting entries?
No.
No.
Needed to bring accounts up to date and match revenue and expense.
Yes.
Yep, that's correct. Optional under GAAP? No, it's not optional. And rarely needed in large companies. No, they're They're needed everywhere.
They're needed probably more.
More,
'Cause they-
well, they're needed everywhere. I'm not really gonna say more, but, they are needed everywhere for sure. I'm not gonna say more or less on that one, but. All right, so the next one, the balance in the prepaid rent account before adjustment at the end of the year is $32,000, which represents 4 months of rent paid on December 1st. So we have prepaid rent. The adjusting entry required on December 31st is, so at the end of December, we're going to make an adjusting entry.
With the balance. I don't understand.
So,
So,
It depends on, but you would get that on so much. So it's like something in the- it's like people-
so we have prepaid rent of 32,000, and I should actually write this over here somewhere, but we prepaid 4 months of rent.
Yeah, so that's our equity, right? The 32,000 is the equity.
The balance of prepaid rent before the adjustment. So the balance in our prepaid rent account is, so we have $32,000 in prepaid rent for 4 months. So we know that 4 months of rent is 32,000. And then this is the balance before the
Rent is
adjustment.
paid on December 1st.
So the adjustment that's required is December 31st. That's when we're making the adjustment. This is the balance prior to the adjustment.
Okay, then it's number 4.
And we made this payment, it says here that
no,
we paid that on December 1st.
So we're taking an asset, which is paid, which is the rent that's being paid. We're taking the asset and taking the 8,000, because we have the 8,000 on December 1st, we have to take out.
Well, the assets, so I would say you would take out the 8,000 and you would credit the rent expense.
Right, number 4.
8,000, that's what I said. But
It has nothing to do with what's left over, because you already said the adjusting entry required on December 31st is.
We're taking 8,000 out of prepaid rent, right? Because it's 8,000 per month, and we've used up a whole month
yeah.
on the 31st. So we're taking 8,000 out of our prepaid rent.
Right,
so that's.
so you have to equal it on the other side of the equal sign.
And we're gonna reduce the expense, right?
Mm.
Because we are paying it.
Yeah. So I think me personally, I think it's number 4. Because you say you're gonna debit to prepaid.
But you still have money.
Because you still have money in the asset.
And you'll
Yeah.
still have money in the prepaid account. So we're gonna debit our rent expense to decrease,
Oh, okay.
and we're gonna credit our prepaid rent expense to
Okay.
take that 8,000 out of there.
Which was number 4 on the other one, on the other side, right?
Debit
No,
prepaid.
number 1,
Credit.
okay, okay.
Yeah,
I see,
that's
I
what,
see.
yeah, that's.
I got it backwards,
Yeah,
okay.
Number 1, yeah.
yeah, that makes sense. But I was like, you're gonna debit it and then credit, I didn't, not number 4.
So first we gotta figure out what the expense is, and y'all did that, 8,000. And then, we've used the 8,000 for that month. So we're gonna pull that out of the prepaid, and, we've expensed it for that month as well. So the journal entry, even though it looks a little jumbled down there, The journal entry is supposed to look like this. So December 31, debit rent expense for $8,000, credit prepaid rent for $8,000.
So what would your additional 24?
You don't do anything with that. Because it's already where it needs to be. So in your prepaid rent account, you've got this 32 sitting here. And so what you're gonna do is it's telling us here, we're gonna take 8,000 out of it. So it's gonna leave 24 in this account. We don't have to move it. It's already where it needs to be, so we're not moving it.
This is just showing an adjustment. It's not creating a balance sheet. You're asking
Yeah,
for.
that's why I was like, it would be two, because in a balance sheet, your 24,000 will still be there, and then you'll see your deductions.
Yeah.
All right, so.
Yeah, it's where it needs to be. We're not moving that anywhere.
Yeah, you're looking for the rest of the information.
The supplies account had a balance of $4,400 at the beginning of the year and was debited during the year for $2,400. Representing the total of supplies purchased during the year, if $400 of supplies are on hand at the end of the year, the supplies expense to be reported on the net income statement for the year is. What is the supplies expense? This one's supposed to be a little bit challenging.
You still be 2,000.
Yeah, that's what I'm thinking. Because you have 400 left, and that will take away from that 2,460.
I don't want to say it.
Hold on.
I want to say 64.
I'm gonna look at it again, but I'm thinking right now in my head. Supplies of the
Because
balance
when they started, they had 4,000 debited, 2,000.
Because I have 4 left on hand, but I'm like, you $6,400.
They had 4,400.
60.
The account was debited 2,400.
Yeah.
and then you have.
So you have 2,000 left.
You have.
It doesn't say what it was debited for, if you have bought more supplies or whatever the case may be. The point is the 2,000 is gone, right?
Is supplies an asset, liability, or equity? Are supplies an asset, liability, or equity account? This is what it's challenging. I think the main reason it's challenging is the terminology.
I think it's still
Supplies are an asset.
because it's an asset.
That's why.
At the end of the day, it's still an asset. Because you started out with 44, even though you debited 2,400. And just because you have $400 supplies, you could have bought those $400 supplies earlier in the year before the 2,400 left. That's my thought process. Like if
I see
$400 of supplies are on hand at the end of the year, has nothing to do with the equation. Because you buy supplies. You can buy supplies in January. Let's say you bought a whole bunch of pencils in January. That's already been debited and gone. And now they're referring to it at the end of the year.
So in accounting, we have to have, we're always going to have a beginning and an ending,
Period.
no matter what. So you're going to have, whatever the beginning balance was. It could be 0. It could be more than likely when you're starting off, it's going to be 0, and then you're going to add money. You're going to buy something, and you're going to put it in there. But you're going to have the beginning balance, and then whatever happens here, and then whatever activity and this could be multiple transactions,
Right.
whatever activity. And then at the end of the period, you'll have your ending balance, which is whatever your beginning balance was,
Minus all the activity.
including all this activity. And the reason I said including is because you could be adding or subtracting. So including all this activity here gives you whatever your ending balance is. So they're saying that the supplies had a balance of
44.
4,400
And it was debited 2,400.
and it was debited. So that's an activity that happened in the account. And 400 are on hand at the end of the year. So our 400 is going to be our ending balance. So supplies is an asset or a liability or an equity.
But how is it it doesn't say 400 balance, it says $400 of supplies. It's not saying,
So
because it starts out, the supplies account had a balance of 4,400.
yeah, I get what you're saying.
The supplies is a physical thing, it's
And it's-
tangible.
But it's an asset.
Okay.
Yeah.
Okay,
So so the supplies account. So like when you think of assets, you have, the building is an asset. Your house is an asset. So the supplies account, in that account, I mean, the stapler could be a supply.
mhm.
So they're saying that at the beginning, they had this amount of dollars worth of supplies. And then throughout the year, we debited that account, this amount. So this amount was debited. Okay. And then at the very end of the year, we were left with this amount. This is what's left in the account. This is all we have left. So
So what's the answer?
what is the expense to be reported on the income statement for the year?
If we have 400 left, I'm gonna say.
Okay, 4,000.
Yeah.
64.
6,400,
Mhm.
the 4,000 plus the 2,400, that was,
That's how much you have to, $68,000 for supply, to spend on supplies.
Supplies is an asset account, right?
yeah,
We debited the asset account, this amount of money, or this value. We debited the asset account of supplies, this amount, and a debit increases an asset.
that's what I got wrong. Okay, that makes sense.
And the reason I do that like that is because it does. Maybe you'll remember it, because I will tell you, and I mentioned this earlier. That always confused me with assets, always. Because like when I think debit, I think of like debit card, taking money out, reducing my bank account, and I'm like, so it always threw me off. So
So it's 60, okay, all right.
so hopefully, so just think about that. Like the first thing is identifying, is it an asset, a liability, or an equity account? And then does it increase with a debit or does it increase with a credit?
The only reason I know this is because dealing with fiscal budgets of the military. Because you've been like, look, you have $50,000 you need to get rid of by September 30th.
Mm-hmm.
And then they're like, all right, well, you've used all your money by, I don't know, July. We're gonna slide you an extra $2,000.
Yeah.
Hence the reason why the additional 2,400 is debited too. They're giving you a little bit more money to handle what you have. But if you have 400 at the end of the year, you didn't spend all your money. So on hand, you basically got a profit of 400 at the end of the day.
Yeah, which still needs to be.
You
accounted
use all your previous money, but you still got a little $400 to tuck it off to the side. If that makes sense.
So you said in your GL account,
Mhm.
I started, the fiscal year starts in October.
Yeah.
And I gave you $4,400.
Mhm.
And,
for. You use it up.
you use it up, and so you moved $2,400 from another GL account
To you.
to continue to cover your supplies for the rest of the year.
Yeah.
So you used up 2,000 of it, but you have 400 left.
Yeah. But
So
you-
that's what's remaining on your GL account for that. It doesn't matter where the 2,400 came from. The point is it's in your account.
Yes.
Okay,
And then you also have that account for that 400 that's left.
makes
That's
sense
it.
now. Yeah. So real life stuff. Helps me.
Liabilities.
Normal credit balance.
Well, I don't know what's considered a normal credit balance, like I'm not.
So I kind of mentioned this earlier, but I know it was like earlier in the very beginning. You kind of need to know this guy.
So it can be either a debit or a credit, depending on whether they use the account or
It's
the
not
credit.
an asset.
Basically, I think of it as whatever increases the account. Because more than likely, you're not going to have a negative account. I mean, if you realistically think I mean, there are negative accounts. So don't, but for the most part, it is expected for you to have an account that has a positive number in it. So the normal balance for an asset account is what increases the asset account. So the normal balance is going to be a debit for an asset.
Okay.
Okay, that's all I should say. What accounts have a normal credit balance?
What accounts have a normal credit account?
Yeah, so for credit,
Or a debit one. For example, because the asset accounts are increased with debit, I'm reading from the book. Are normally have debit balances. Likewise, liability accounts normally have credit balances.
So it's a liability account.
So liabilities and equity. Anything outside of assets.
whatever increases it. So remember, so moving away from the zero. So a liability account increases with a credit because it's on the right-hand side of the T account. An asset account increases with a debit because it's on the left-hand side. I'll see if I can find a video on that.
Hold on, I'm writing this down.
But yeah, accounts that have a normal credit balance are going to be your liabilities, your liability and equity accounts. And then there are other accounts within those. Like you see here, the Contra Asset, your gains, revenues, all of those are found on the right-hand side of the accounting equation. What accounts have a normal debit balance?
Assets.
Your asset accounts, cash, accounts receivable.
Risk.
Fixed assets.
So normal debit balance, assets, expenses and losses, cash, accounts receivable, prepaid expenses. The type of account and normal balance of an unearned consulting fee. An unearned fee, what is the type of the account and the normal balance?
Unearned revenue. No, unearned fee.
Which says the type of account and normal balance of an consulting fees.
Oh, you know it?
Four.
Oh. I was like waiting for you to ask the question. Number 4. No. Close. So the normal balance of an unearned consulting fee.
Oh,
So we've received the cash, but have not performed the services.
but have not.
So it's a liability.
Mhm. That's what I'm trying to figure out.
And we owe the services to the client. Oh, because it's unearned. So unearned because it's like unearned revenue.
Yep.
Unearned fee. It's the same thing because they just call it something different, but it's your fee that you're charging. So it's technically revenue. You just have not yet earned it. So that's why.
That's why I'm being like that. Oh, I see where credit comes in. Okay.
Yeah. That's the last one for that one. So I'm going to pause this.